Let's look at David. He is 29 years old, earns 75,000 shillings a month, and prioritizes career flexibility above almost everything else. To maintain that lifestyle, he currently pays 28,000 shillings a month to rent an apartment in Ruwaka. His mother gives him the standard advice: buy a house, settle down, build a foundation. But David runs the numbers differently. Sinking millions into a cement block drains his liquid cash and ties him to one location. For him, renting is a calculated premium. He pays a landlord so he can pack up and take a new job across the country with 30 days' notice. Then the government passed the Affordable Housing Act of 2024. This diagram breaks down his new reality. A non-negotiable 1.5% housing levy is now sliced off David's gross salary every month, and his employer is legally required to match it, sending the total straight to the Affordable Housing Fund. Here is where the math starts to hurt.
David is taking that 1.5% hit while simultaneously draining a massive chunk of his remaining income into a private landlord's bank account. The national fund he is paying into is accumulating billions of shillings to construct homes, while he continues to pay retail market prices for his own shelter. The 1.5% levy effectively turned David's lifestyle preference into a structural financial reality dictated by unavoidable taxation. To understand why the state is pulling this money from his paycheck, we have to look at the law. Article 43 of the Kenyan Constitution guarantees every person the right to accessible and adequate housing. The courts have ruled that the government cannot sit on the sidelines here. They have a duty of progressive realization, meaning they are legally obligated to actively solve the housing deficit. The Affordable Housing Program is the specific legislative tool built to fulfill that mandate. The law is strictly structured to put roofs over heads, not to create high-yield investment vehicles for private capital. The state views the AHP as a constitutional imperative, and they are using David's tax contributions to fund it. This pyramid chart shows AHP products categorized strictly by income. At 75,000 shillings, David falls directly into the middle affordable housing bracket. Under the 2025 regulations, the government dropped the standard 10% deposit requirement to 5%. That specific reduction makes homeownership mathematically feasible for earners, who would normally be locked out by the massive upfront cash requirements of the private market. The Act also enforces a strict one-unit-per-person rule. The administrative gatekeeping prevents wealthy investors from buying up blocks of apartments to flip or rent out. The units are reserved for primary residents. The government has deliberately engineered the financial barriers and the legal regulations to pull mid-income earners like David into the ownership bracket. The product being sold here is security of tenure. That means legal protection from sudden eviction notices or arbitrary cost spikes. In Ruwaka, David is vulnerable. His private landlord can raise the rent next year or terminate his lease if they decide to sell the property. But that security requires a heavy, long-term financial commitment and the physical responsibility of maintaining an asset. Owning a unit anchors David. He can no longer chase a promotion in another city without figuring out what to do with his property. He has to weigh the volatile freedom of the private rental market against the anchored security of a state-backed asset. Let's look at this decision tree to settle the debate. The calculation hinges on one question: are you staying in Kenya for the next 5 to 7 years? If moving abroad in the near future, the math points to keeping liquid cash and continuing to rent. If staying, he faces the next node. Can he redirect his 28,000 shilling monthly rent toward a 5% deposit and a tenant purchase scheme? Redirecting that cash flow turns a monthly expense into inflation-proof equity protected under Article 43. If his timeline is long enough, remaining a renter means paying the entirety of his housing costs to build a landlord's wealth, while his taxes simultaneously fund the National Housing Project. This chart compares the two outcomes over a decade. On the left, paying 28,000 shillings a month in rent equals over 3.3 million shillings in sunk costs. On the right, that exact same capital deployed into the AHP builds 3.3 million shillings of permanent equity. The 1.5% levy is already leaving David's paycheck. The state is already taking the capital. Taking advantage of the AHP is a strategic recapture of his own tax funds. You are already paying for the affordable housing program. The only question left is whether you intend to let someone else use your money or use it yourself.